Hello everyone and welcome back to my channel. In this video, I'll be teaching you about one of the most important yet underrated skills in trading, which is how to manage your stop loss while you are in a trade. A lot of traders here on YouTube demonstrate how to enter a trade, but only few of them show you how to manage it. And honestly, most traders screw up during the trade itself, not before. I know you guys can relate to that. So I will cover when to reduce it to avoid a full loss. So if you have been trading for a while, I'm 100% sure you are familiar with the following scenarios. Maybe you are entering a trade and it starts moving in your favor for a while. You then move your stop loss to break even, but the price hits your modified stop loss and then reverses to reach your take profit. Another scenario is entering a trade, having the price go in your favor and then sharply reversing, and now it is coming close to take your stop loss. And instead of manually closing the trade for a small loss, you hold on, hoping for another reversal to your TP, but eventually it hits your stop loss. So in this video, we will fix all these problems. Imagine being able to know exactly where and when to move your stop loss and minimizing the chances of taking a full loss. I'm pretty sure you would like to acquire the skill. So if you are interested in this topic, and I'm pretty sure you are, then stick around till the end. And don't forget to hit that like button and subscribe to my channel so you won't miss any upcoming videos. And let's get started. So the structure of this video is going to be as follows. I will show you 4 factors, 4 price action patterns. If you see these on the chart, you need to reduce your stop loss. I don't like to call them patterns, but for the sake of simplicity, we will refer to them as such. I'm also going to give you the exact logic behind them so you can understand them better instead of just memorizing them. I learned these price action patterns by experiencing dozens of losses and studying each one of those losses. Through this process, I was able to come up with a high probability trade management plan that made my loss small and my wins big. Now let's start with the first one. And now the first pattern that when you see, you need to consider exiting your trade, which is the mean threshold of an order block. By mean threshold, we mean the 50% of that order block. Now, what do I mean by that and how to use that to exit your trade? Follow along with me. Now, suppose you have a displacement, right? And I believe that most ICT traders, displacement is a condition to enter a trade. So we have a displacement right here. And that displacement, in most cases, it will leave an order block behind. And especially if you have a sweep on liquidity just before the displacement. In our case, this is the order block, right? An order block is the consecutive down close candles before the energetic displacement right here. Not the last candle, but the consecutive candles right here, right? So what you want to do is you want to outline the 50% of that order block right here. And this is the mean threshold. So suppose you take the trade on this level right here. So you take the trade on this level. Maybe there was here a fair value, yep. So the 2022 model, and you entered from here and your TP is somewhere around here, right? That is irrelevant at the moment. So you take the trade and price from here start doing maybe this, right? And then starts going into your stop loss and into this order block. Now, what do you want to do here is to monitor the bodies of the candles when price reaches to this mean threshold. So if you see, for example, the bodies of the candles are violating this mean threshold, so the candles out here are closing below the mean threshold, then you need to exit the trade somewhere around here. If you see the bodies of the candles are closing above the 50% level, so the mean threshold, and there are wicks right here, so that's normal. You don't touch your stop loss, you don't move anything, you leave it alone, all right? So the only scenario is when you see the bodies of the candles are closing below the mean threshold line. Now, let me remind you that you need to monitor the candles on the same time frame as the entry. For example, if this is a 5-minute structure, as you can see here, then you need to monitor 5-minute candles. So don't go to 3-minute candles or 1-minute candles. On the 1-minute candles, you will see body closures below the 50% line, right? But if you go to 5-minute, then you will see only wicks. So to summarize things up, what you want to do is when price is reaching to that order block, in case it reached then, sometimes it will just fill this fair value gap right here, maybe or a breaker block and reach your TP. If that is not the case and price reach to that order block, you want to monitor the candles when price hits it and it is approaching the mean threshold. If you see only one candle, its body closed below the mean threshold, then you need to get out of the trade and take partial loss instead of the whole loss. Now, this is not 100% probability that whenever you see candles closing below the mean threshold, that means that it will go here, but 90% of the time or 80% of the time, price will just continue to take this and violates this whole order block. So we are playing the game of probabilities, all right? The second price action pattern, which is the continuation purge. I use this pattern all the time and I have dodged a lot of losses because of it. Now, how does that work? Let's say, for example, we have this structure right here, a displacement, and you entered from this fair value gap, for example. Fair value gap, or maybe you entered on this order block, it doesn't matter. So now price starts doing this, right? It starts going into your favor and then breaking this swing right here. And now you are considering to move your stop loss from here all the way to here, right? Because that's how retail thinks. So price made here a swing, right? And now you are expecting a higher swing low right here. You are not expecting price to take this lower swing right here. And most of the time price will do this. It will go all the way to here to take this swing and then immediately reject and go to your TP. I have seen this so many times. I have took a lot of losses just because of this. I see this, right? I see this swing get broken and then I move my stop loss to here and this continuation purge will immediately take my stop loss and go to my TP. Now, the logic of this continuation purge is to take stop losses from here. So retail traders, whenever they see this formation right here, so an expansion and then a retracement and then a small expansion right here, they will think that their stop loss is safe right here, and it is the opposite. The market will use these stop losses right here as a fuel to reach that intended level. So although you are right on the higher time frame, you have the right bias, you will get wrecked on the lower time frame. And I believe most of you have experienced that before. You have the right bias, but you get wrecked when you go to the lower time frames. So how do we use this continuation purge in our favor? So what you want to do is whenever you see this continuation purge, you want to reduce your stop loss to here, just below that swing that took liquidity from here. And price, if price is actually in a buy program, it should not go all the way to here and violates this swing and then continue to the upside, right? It should not do that. Why? Because this swing already took liquidity. I have talked about this many times before. Price should not go all the way to here and take more liquidity because it already did. And the market makers doesn't want retail traders to participate in this move right here to that higher time frame level, right? So again, whenever you see a continuation purge, that's your cue to reduce your stop loss. Now this can happen here also. So you see now price starts going to your favor and then immediately rejects lower, take the stop losses from here. So this is kind of a turtle soup on the lower time frames, and it is a very powerful entry model. If you want to pyramid, maybe you entered from here and then you want to add another position, then the continuation purge is a great way to do that. So here you can add more position to it and price will start going up. You have another continuation purge right here, and this is your cue to move your stop loss from here to here. And price, if it's in a buy program, it should not go all the way to here. And if for some reason it starts reversing and violates this, right, and this swing low right here, it will, in most cases, it is likely to continue down and take your original stop loss. Again, this is a game of probabilities, right? So this is not 100% method, but in most cases, if price takes that swing that caused the sweep on the liquidity right here, it will just keep going down and take your original stop loss, right? So the second element, the second price action is the continuation purge. And now let's move to the third one. And now moving on to the third price action pattern, which is the intermediate term high or the intermediate term low. Now ICT talked about this particular swing, type of swing in the 2022 mentorship, right? So I believe the 12th episode, it's called Advanced Market Structure for Precision Technicians. And basically, there is two types of an intermediate term swing. Let's say, for example, intermediate term high, all right? So we have maybe an expansion right here. That expansion will leave a fair value gap. And now when we have a retracement and then forming a swing, and that swing balanced that fair value gap right here, then this swing automatically called an intermediate term high, right? And this is the first type of intermediate term high. Now, we are not going to use this, but we're going to use the second type of an intermediate term high, which is something like this. So maybe with an expansion, some kind of structure right here. So this middle swing right here is called intermediate term swing or intermediate term high. Why? Because it has a short-term high to the left of it and a short-term high to the right of it. We don't need the fair value gap right here, all right? It can be any point of interest. So the logic here is that if we are in a sell program, in this case, price should not go and violate this intermediate term high, right? It can go all the way to here, to this short-term high, but it should not go all the way to here. So this is a perfect level to put your stop loss, right? So this is a protected high. Now, in our example right here, if, for example, you see something like this, so as you can see, this swing right here, we can label it as an intermediate term low. Why? Because it has a short-term low to the left of it and a short-term low to the right of it. So now we can reduce our stop loss to this swing right here, and now we can expect that the market will not go all the way to here. If in fact we are on a buy program, right, then price should not go all the way to here and violate this swing. And in case it did, now there is a high probability that the market will just keep going down and break this whole structure right here. So again, whenever you see intermediate term low in case of a long position or an intermediate term high in case of a short position, now you can safely move your stop loss just below that swing right here, and it is a protected swing. And now moving on to the last price action pattern or price action formation, that whenever you see, you need to consider decrease your risk exposure, right, or exit that trade. And the last one is the 3 PD array rule. What do we mean by that? So basically, if we are in a buy program, when you see that price is violating 3 arrays in a row, so 3 bullish arrays, then you need to consider exiting that trade, because maybe that buy program is over and now we are reversing. So basically it looks something like this. Let's say, for example, price starts doing this. So you entered from this area right here. Maybe we have a fair value gap right here. And then price starts going in your favor and it does something like this, right? And then we have a displacement right here. So you enter the trade here, right? And your stop loss, original stop loss was here. So now we have a new structure in our hand, right? So this structure left a breaker block right here. It left a fair value gap and also left an order block. So we have a breaker block, we have a fair value gap, and we have also an order block right here. And also we have this swing low right here. So this is also considered as an array. All right. So now we are expecting some kind of a retracement to one of these PD arrays, right? And price continue to the upside and reach your TP and eventually reaching your TP, right? But when you see that price starting to violate the first PD array right here, which is the breaker block, and then closing below that fair value gap and eventually closing below that order block, or simply you can use the mean threshold of that order block, yeah? So remember the first part of this video. Now you need to exit the trade to take a partial loss or a break even instead of the full loss right here, right? So whenever you see 3 PD arrays gets violated, now you can expect that price is gonna reverse. And let me remind you that you need to stick to the time frame that you entered the trade from. So if you entered on the 5-minute time frame, then you need to monitor this pattern right here. So this 3 PD array rule in the 5-minute time frame. Don't go to the 1-minute time frame and you see 3 or 4 PD arrays gets violated and now you exit the trade. No, stick to the time frame that you entered from. So to summarize things up, whenever you see the mean threshold of an order block gets violated, or you see a continuation purge, or an intermediate term high or intermediate term low formation, or 3 PRAs gets validated in a row on the same time frame that you entered from, then it's probably time to exit the trade. So you can use all of these information that I have told you to manage the trade and manage the stop loss, or you can even use it to enter trades, right? So maybe you can enter from that order block whenever you see that candles are not closing below that mean threshold. So now this is kind of high probability order block, or you can enter from a continuation purge, so a turtle soup, or you can enter whenever you see that short-term low or high that's formed after that intermediate term high, right? So you can put your stop loss above or below that intermediate term swing, or finally you can enter maybe from that breaker block and you can put your stop loss below this swing right here. So now it is protected by 3 PDRAs, right? And you are totally safe if your bias is right. So I believe we have come to the end of this video. If you have any questions, please DM me in my Twitter account or leave a comment down below and I'll answer you as soon as I can. Happy trading and good luck.